Every generation believes that the economy has changed forever. Every generation believes that this time is different. But when you look at history carefully, a surprising pattern appears. Economic cycles repeat. Down, bubble, crash, recovery. Then the cycle begins again. Understanding these cycles does not make you a fortune teller, but it helps you avoid the biggest mistakes people make when emotions take control of markets. Today we will break down why economic cycles repeat, what drives them, and how you can recognize the signs before the next shift happens. This is Capital Clarity, a channel where we explain how money works clearly, simply, honestly. When the economy is growing, it feels like growth will continue forever. Businesses expand, stocks rise, real estate prices increase, new companies appear everywhere, people become optimistic, investors become confident, banks become more willing to lend money, governments encourage spending. At first, this growth is healthy. It reflects real productivity, innovation, and economic expansion. But over time, something changes. Optimism slowly turns into overconfidence, and overconfidence creates the conditions for the next stage of the cycle. Every economic cycle begins with expansion. After a recession, interest rates are often low. Borrowing becomes cheaper. Businesses begin investing again. Consumers begin spending again. Employment increases. Confidence grows. This is when the economy rebuilds. New technologies emerge. New industries grow. Investments made during this phase often produce strong long-term results. But expansion does not continue forever. Eventually, growth becomes so strong that risks begin to accumulate. As the economy grows, banks start lending more aggressively. Loans become easier to get. Businesses borrow to expand faster. Consumers borrow to spend more. Credit fuels growth, but it also creates vulnerability, because borrowed money must eventually be repaid. When borrowing increases faster than real economic growth, the system becomes fragile. Debt grows faster than income. At first, no one notices, because asset prices are rising. When easy money and optimism combine, bubbles begin to form. Asset prices rise quickly. Stocks, real estate, cryptocurrencies, new technologies. Investors start believing prices will only go up. This is where psychology becomes more powerful than fundamentals. People stop asking, "What is this asset worth?" Instead they ask, "How much higher can it go?" Speculation replaces investment. Risk becomes invisible, and the cycle moves closer to its turning point. The peak of the cycle is rarely obvious while it is happening. At the peak, economic data still looks strong. Employment is high. Companies report profits. Markets are still rising. But underneath the surface, imbalances have grown too large. Debt levels are high. Asset prices are disconnected from reality, and the system becomes sensitive to shocks. Sometimes the trigger is small. A bank failure, rising interest rates, a sudden loss of confidence. But once the turning point begins, momentum reverses. When a bubble bursts, prices fall quickly. Investors panic. Credit tightens. Banks reduce lending. Companies slow down hiring and investment. Consumers reduce spending. Fear spreads to markets. This is when recessions begin. The crash phase feels chaotic, but it follows the same logic as the boom. Excess debt must be reduced. Overvalued assets must return closer to reality. The system resets itself. During a recession, economic activity slows significantly. Businesses close. Unemployment rises. Investment falls. Confidence disappears. Governments often respond by lowering interest rates or increasing spending. Central banks try to stabilize financial markets. These actions help stop the downward spiral. Eventually, the economy reaches the bottom of the cycle. Recovery begins slowly. At first, it feels fragile. But gradually, businesses start investing again. Consumers regain confidence. Employment improves. Markets begin rising again. New industries emerge. Old companies adapt. And the economy enters another expansion phase. The cycle restarts. Economic cycles repeat for three main reasons: human psychology, debt, and policy responses. Humans are emotional. When times are good, people take more risk. When times are bad, people become cautious. These emotional swings amplify economic movements. Debt also amplifies cycles. Borrowing accelerates growth during expansions, but it also magnifies losses during downturns. Finally, government and central bank policies influence cycles. Lower interest rates encourage borrowing. Higher rates slow the economy. These tools help stabilize the system but also contribute to long-term cycles. History is full of repeating economic cycles. The Great Depression of 1929 followed a massive stock market bubble and credit expansion. The dot-com bubble of 2000 grew from excessive optimism about internet companies. The financial crisis of 2008 developed from extreme leverage in housing markets. Each cycle had different technologies and different industries, but the pattern remained the same: optimism, speculation, excess debt, correction. One reason cycles repeat is that people forget the previous cycle. New generations enter markets. They did not experience the last crash. They believe current conditions are unique. This creates the illusion that risks are smaller than they actually are. Memory fades, optimism returns, and the cycle begins again. Understanding economic cycles does not mean you can predict exact timing, but it changes how you behave. Smart investors avoid extreme optimism during booms. They remain cautious when prices become disconnected from fundamentals. They build reserves during good times, and they look for opportunities during downturns, because recessions often create the best long-term investment opportunities. When fear dominates markets, prices become attractive again. Economic cycles are not accidents. They are natural outcomes of human behavior and financial systems. Booms encourage risk. Risk creates excess. Excess leads to correction. Correction resets the system. Then growth begins again. The cycle continues. The goal is not to fear economic cycles. The goal is to understand them. When you recognize the patterns, you stop reacting emotionally to every headline. You realize that booms and recessions are temporary phases of a larger system. And when the next cycle inevitably arrives, you will not be surprised, because you will already know. Economic cycles always repeat.